Welcome to this explainer. Today, we're diving straight into Tesla's futuristic tech leaps and the hidden, kind of fascinating boardroom mechanics that actually make them possible. If you follow the electric vehicle and AI spaces at all, you already know that Tesla operates at a breakneck speed that completely defies traditional corporate boundaries. But honestly, how exactly does a company simultaneously build humanoid robots, orbital supercomputers, and self-driving fleets, all while managing the massive internal pressures of corporate oversight? Well, that's the exact tension we're going to unpack today.
Here's a quick look at how we'll break this down. We're going to start with Musk's trillion-dollar bets, move into the governance paradox, look at agency versus stewardship, tackle that massive $56 billion question, and finally wrap up with balancing vision and oversight.
All right, part one, Musk's trillion-dollar bets, covering SpaceX, AI, and robotaxis. $1.25 trillion. I mean, let that number sink in for a second. That staggering figure represents the valuation of the historic private merger creating the SpaceXAI brand. In early 2026, SpaceX, which was valued at a cool $1 trillion, officially absorbed xAI, valued at $250 billion. This completed the largest private merger in history. The big takeaway here is really the sheer audacity of the goal. They're trying to build a network of orbital supercomputers in low Earth orbit. By combining xAI's software stack and its massive Colossus supercomputer infrastructure with SpaceX's rockets and the Starlink network, they're aiming to literally escape the energy constraints of Earthbound AI development. It's a completely unprecedented consolidation of a rocket manufacturer, a satellite internet provider, and an AI software company.
Meanwhile, back down here on Earth, the ambition is just as aggressive. Tesla recently rolled out its fully autonomous, unsupervised robotaxis down in Miami, Florida, and this is a massive milestone. If you've ever tried to navigate airport traffic, you know exactly how chaotic and complex that environment is, right? So this proves their autonomous driving platform is rapidly expanding way beyond its initial testing grounds in California and Texas. By operating these unsupervised rides in a dense, airport-linked geography like Miami, Tesla is directly challenging established players like Waymo right on their own turf. Market analysts are watching this incredibly closely. They're noting that if this scales smoothly into other cities like Orlando and Tampa, it provides real-world proof that their autonomous platform could fundamentally shift the company's long-term earnings potential.
And you know, this incredible speed extends way beyond just vehicles. Think about the shockingly fast evolution of the Optimus robot. What started out as a literal person in a robot suit back in 2021 has evolved into a massive industrial shift. In just about 4 months in early 2026, Tesla literally dismantled its legacy Model S and Model X assembly lines at the Fremont factory and installed entirely new, modular equipment specifically for the Optimus Gen 3 production line. They already have over 1,000 Gen 3 units operating and actively learning inside the factory. Limited production is slated for late summer 2026, with a much larger facility actively under construction in Texas that's aiming for a capacity of potentially millions of units a year.
But even with all this massive hype and the rapid factory conversion, Musk himself is actually tempering expectations a bit. He stated recently that Optimus production will be extremely slow at first because everything is new, explicitly saying this is not like making a car. He's highlighting the immense engineering hurdles they're facing here. I mean, this robot has roughly 10,000 unique parts. Pioneering a humanoid robotics supply chain from scratch, literally inventing new automation techniques and actuator supply chains in real time, is vastly different from Tesla's established automotive operations, which get to rely on a century of refined industry processes. So they are heavily prioritizing iterative improvement over rushed volume.
Okay, let's pivot to Section 2, the governance paradox, oversight versus innovation.
So what is corporate governance anyway? Basically, it's this system of rules and practices that balance the interests of a company's stakeholders. Now, according to a 2025 academic working paper by Tomás Luero, Tesla's explosive growth is currently on a direct collision course with orthodox corporate governance. Luero points out that maintaining strong traditional oversight becomes incredibly difficult in high-growth technology-driven environments, especially when power is highly concentrated at the top.
Which brings us to a really fascinating core tension. Is centralized power a bug, or is it a feature? Defenders of Tesla's board structure will tell you that without Musk's hands-on, highly centralized leadership, bold moves like ripping out a profitable car assembly line just to build robots simply wouldn't happen. A traditional committee would probably stifle that pace. But on the flip side, critics warn that this extreme concentration of authority exposes the company to massive reputational and regulatory risks.
And we're seeing this boardroom tension translate into actual real-world friction.
Take California's recent $135 million EV incentive program, for example. It structurally bypasses Tesla entirely. The program caps eligible vehicle prices at $50,000, but then completely exempts automakers headquartered in California, like Rivian and Lucid, regardless of how much their cars cost. Now, because Tesla moved its corporate headquarters from California to Texas back in 2021, amid what have become pretty widely reported adversarial political dynamics between Musk and California's governor, Tesla is left at a huge structural disadvantage. It's a perfect example of how leadership dynamics and corporate positioning can directly impact a company's regulatory environment and ultimately its bottom line.
Moving on to Section 3, Agency versus Stewardship, two leadership theories.
Academics usually look at these leadership dynamics through two very different theories. Under agency theory, a CEO with unchecked authority is viewed as a risk. They might pursue rogue actions that diverge from what's actually best for the shareholders. But conversely, stewardship theory argues the exact opposite for founder-led companies. It suggests that a CEO, especially one with a massive 17% stake in the company like Musk has, acts more as a benevolent, mission-driven steward. By this logic, empowering a visionary founder aligns perfectly with investors' long-term returns, simply because the founder's financial fate is tied directly to the company's success.
However, if you look at this through the lens of agency theory, critics point directly to events like the infamous 2018 funding secured tweet. Musk tweeted out to the world that he was considering taking Tesla private and had funding secured. This was an action taken completely without any board vetting. Now, sure, it temporarily inflated the stock by 11%, but it quickly invited SEC sanctions, forced Musk to step down as board chairman, and led to a $40 million settlement. It was quite possibly one of the most expensive tweets in history. Loureiro's paper highlights this as a textbook example of poor oversight, where a total lack of checks and balances allowed impulsive behavior to introduce severe regulatory risk to the shareholders.
That brings us to Section 4, the $56 billion question, a historic pay package. $56 billion. That unprecedented, astronomical sum is the size of the controversial performance-based compensation package that was awarded to Musk back in 2018. Now, to be fair, the package was tied to incredibly aggressive market capitalization goals that were actually met, multiplying Tesla's value tremendously. However, Delaware courts recently criticized the package heavily. They stated it was an unfathomable sum that was engineered by a conflicted board that lacked true independence from the CEO.
But here is the truly fascinating part, the shareholder reaction. Instead of just scrapping the deal after the court ruling, Tesla put it back up for another vote. And despite some really stark warnings from proxy advisors and large institutional investors, a massive 72% of non-Musk shares voted to approve the package all over again. The shareholders actively chose to reaffirm their CEO's vision and performance over traditional orthodox governance norms. It's this wild paradox where standard accountability mechanisms are effectively overridden by the sheer trust the retail investor base has in the founder.
But Loureiro's research is quick to point out that this extreme loyalty definitely has structural costs. For one, Tesla has experienced the departure of over 40 senior executives since 2018, which hints at a potential lack of a stable leadership pipeline right beneath Musk. Furthermore, in direct response to the Delaware court striking down his pay package, shareholders also voted to relocate Tesla's state of incorporation away from Delaware to Texas. This is widely viewed in the corporate world as a defensive maneuver to bypass those strict court rulings and shift to a much more management-friendly jurisdiction, which carries long-term structural implications for oversight.
And finally, Section 5, balancing vision and oversight to protect the future. To actually sustain its trillion-dollar valuation across space, AI, and robotics, Tesla is facing a critical transition phase right now. Loureiro's research demands a specific governance checklist to get this right. The key goals? Appoint a truly independent lead director. Revitalize the board with objective legal and audit experts, not just corporate insiders. Ensure transparent pay, establish crystal-clear succession planning, and actually enhance how they listen to shareholder concerns. They basically need to figure out how to maintain their incredible momentum without stifling innovation, while simultaneously reassuring those big institutional investors.
And to be fair, we are seeing some slight movements towards this exact checklist. For instance, Tesla recently appointed Jack Hartung, a longtime Chipotle executive, as their new lead independent director. However, as the academic research notes, his prior corporate ties to Elon's brother Kimball Musk, who actually served on Chipotle's board during Hartung's tenure, still raised some academic questions about true, unconflicted independence. So it's a step in the right direction, but perhaps a cautious one.
Ultimately, this explainer leaves us with a really provocative question about the future of corporate oversight.
Can a founder-led behemoth truly embrace structural accountability and mature governance without losing the very spark, speed, and maverick spirit that made it revolutionary in the first place? As Tesla continues to push the absolute boundaries of human technology, its ability to master its own boardroom might just be its most important engineering challenge yet. Thanks so much for joining me on this explainer, and definitely keep your eyes on how these boardroom battles continue to shape the technology of tomorrow.